Good afternoon, everyone. I hope you had a great Friday and getting ready for nice weekend. In today's webinar, we're going to talk about how to trade stocks and why it's good to have them in your portfolio. This is Mr. Saltik speaking from FXC. First, we need to first understand the basic concepts. Then I will go dive deep on the few issue, but it will be just a 30-minute short webinar regarding stocks. Why do you need in your portfolio? How can we help you with the trading strategies and etc. So first of all, the first question is why? What does it mean to invest in stocks? Investing in stocks means you are buying equity in a company, is a share in a company. In other words, you're a part owner. Even if you only own a tiny fraction of the company, you can invest in stocks by purchasing whole or fraction shares in companies. You can also buy mutual funds or exchange traded funds that invest in stocks, but we will not go into details regarding to that. It will be like an introduction to stock investing from our platform, from FXC. So how do you start investing in stocks? The first thing you need to invest in stocks in access to the market through like a brokerage company like FXC. The process of opening an account at FXC is very easy. You can watch guide videos on our website, how to open accounts, how to fill the forms for KYC, and how to upload your documents and etc. The next step is to identify which stock do you want to buy and how much do you want to invest in a particular stock. You need to do your research, obviously, and evaluate the risk according to your risk appetite before you make the decision. But maybe you can say that you don't know any financial knowledge or you don't have any in-depth knowledge in the companies that you want to invest, but you just know the names. You can also get market commentaries, market news from our team members, and you can invest accordingly. And actually, after deciding which stock to buy, it's easy to take trade accordingly. The important part is just making research and making decision about which stock to buy or sell according to market conditions. So stocks can be a valuable part of investment portfolio. Obviously, owning a stock in a different companies can help you build your savings, protect your money from the inflation and taxes, as you can also experiencing even the developed countries having the issues in inflation, like United States and UK for now. And also you can maximize income from your investments. It's important to know that there are risks, obviously, when investing in stock market, like any other investment, if we compare, but it helps to understand the risk and return relationship and your own tolerance to risk. So that's what I told as a risk appetite. So you can invest accordingly. When you have a portfolio of heavily concentrated on a handful of companies or just a few industries, if one company or industry goes down, then your whole portfolio goes down. So that's why there's a term called diversification. Is a key here. Diversification means helps to make sure that doesn't happen, or at least provides a cushion if one area the free falling down. So you will be safety net in your investments if you diversify your portfolio. I will talk in detail in the last parts. Investors should have no less than it's like a rule of thumb, general rule of thumb. Obviously, you can start with less, but investors should have no less than 60 stocks in their investments in order to have a well-diversified portfolio. It's the base case scenario, obviously. If you don't have time to research but want to start investing, you can consider low-cost a broad market index fund instead. One of the best ways to mitigate risk and ensure a diverse portfolio is to invest in low-cost broad market index fund, as I mentioned, such as S&P 500 fund or a total market. It's a total market fund, even funds devoted to a cross section of the market, like technology and small cap funds. You will get familiar with these terms, like what is small cap, what is big cap, what is blue chip companies. These are the terms that in the financial markets uses. So if you don't as I mentioned, if you can't start with the one company or just individually investing in the companies, you can consider investing on index funds. As I mentioned, it's a great way to achieve instant diversification. They track overall market or some portion of it. It can be like a 500 biggest companies, like a 30 biggest companies. It depends on the index, which index fund we are talking about. So you can by this way they just allow you to invest in hundreds of companies with one transaction. Many people use this as a primary investment vehicle, not only because of their efficiency, but because you don't need any prior knowledge to start investing. And they also have extremely low fees. It's better start with what you know. A good way to start thinking about potential stock is to consider the companies and brands used every day. There are a number of resources and tools available at FXC also that may help you guide your decisions about investing in companies that you are interested in. You can check the website. You can see the blue chip companies, big ones, the big techs, or big big biopharma companies that you can buy stocks immediately in our platform. The largest difference, for example, we are a forex brokerage company. You can also invest in currencies and other than stocks. If you compare what is the difference between forex investing and stock market, of course, when in forex, in a foreign exchange as a short term, is a marketplace for buying and selling of currencies, while the stock market deals in shares, the units of ownership in a company. So primarily your decision about whether to trade currencies or stocks should be based on which assets you are interested in trading. But there are some other factors you need to consider as well. Stock market sees comparatively fewer trades per day, for example, if you compare with forex trading, but shares are still easy to access and trade, so they are not illiquid. Large popular stocks such as Apple, Microsoft, or Facebook are the most liquid, as they are usually willing buyers and sellers. Liquid means that you can trade easily and that in the market you can find buyers and sellers easily. But once you move away from blue chips, as we talked, the biggest tech companies or biggest companies in the revenue size in their quarterly reports. And if you there is often significantly less liquidity if you move away from the blue chips. Another factor to consider before trading forex or shares is what moves market prices. Primarily, both markets are influenced by supply and demand, obviously as a basic rule in economics, but there are a host of other factors that can move prices. You can watch the news, you can see how it affects from the political decisions in the war zones and other things that affect the stock prices. It can be a speculation in social media. So there are many things to consider to affect the stock prices as well. When share trading, you will need to focus on few factors that directly impact the chosen company, that your chosen company, including companies' debt levels, cash flows, earnings, as well as economic data, news reports, and sector health. So there are many factors to consider on investing in stocks. But if you are beginner, if you are not familiar with these terms, and if it's hard for you to check these stats and facts about companies, it's better to have a working with the retention managers and working with someone who has experience in trading. And because you shouldn't have to worry about your investment, and also you shouldn't have to hurry up about your investments, and you need to have mental clarity about the chosen stocks in your portfolio. So as I mentioned before, why we can explain that why it benefits to have a low volatility stocks in your portfolio. Before we dive into benefits of having a low volatility stocks in your portfolio, you may ask yourself, what is volatility? In investment terms, the volatility of a stocks market price is a measure of how why the price actually fluctuates, how the price actually moves on downsides or upsides. The volatile market is characterized by wide fluctuations in the price and often large volumes of trading as the people rush to sell stocks in a panic or buy stocks on a good news. It's out of fear or missing out. Uh, Volatility is also used as a measure of risk. If stock is volatile, you can expect large swings in its price, therefore a higher chance of making us losing money. In layman's terms, the high volatility, the more of an emotional roller coaster journey investors may experience. If the current economic and political situation is calm and there's much uncertainty about the near future, most information will be priced into the stock market, making stock less volatile. Meaning, in other words, the stocks won't move about too much since people don't expect too many things to change. There have been long periods of time when volatility remained low. Then, however, there are some also times like financial crisis in 2008 or the 2020 unexpected arrival of coronavirus pandemic that caused high levels of uncertainty, resulting in so-called volatile spikes in the market. So for the recap, volatility is a use or measure of risk. Stock volatility driven by number of factors, from state of economy to human psychology. High volatility often implies a bigger risks. Now let's talk about the advantages of stock investing. First advantage is you will take advantage of growing economy. So as the economy grows, so the corporate earnings grows. That's because economic growth creates jobs, which creates income, which creates sales. The the fatter the paycheck, the greater the boost to consumer demand, which drives more revenues in the company's cash registers. It helps to understand the phases of a business cycle: expansion, peak, contraction, and true. So it's you will take advantage of growing economy. Another advantage is it's actually the best way to stay ahead of inflation. So historically, over the long term, stocks have been yielded a generous annualized return. For example, as January 2000 in 2022, 31st of January, the 10-year annualized return of S&P 500 was 15%. That's the better than average annualized inflation rate. It does mean that you must have a longer time horizon. However, that way you can buy and hold even if the value temporarily drops. And it's easy to buy. Another advantage is it's easy to buy. Stock market makes it easy to buy shares of companies. You can purchase them through a broker like FXC. Once you have set up an account, and it's also easy process, you can buy stocks in minutes. If you're a small business owner, you may even able to invest in stocks through your business. Another thing is you can make money in two ways. Most people think that if you that you can make money when the stock price goes up, but also you can earn money when it goes down as well if you trade contrary to the market. Most investors intend to buy low then sell high. They invest in fast growing companies that appreciate in value. That's attractive to both day traders and buy or hold traders, investors. You will when you start investing, you will familiarize yourself if in which category are you in. It depends on your time expenditure on trading and your willingness to invest, willingness to learn about markets. Of course, in the first group, if you are day traders, you want to hope to take advantage of short-term trends, while the latter expect to see companies' earnings, stock price grow over time. But as a day trader or like a middle level trader, is a buy and hold strategy. They both believe the stock picking skills allow them to outperform the market. Other investors prefer a regular stream of cash. Maybe they purchase stocks of companies that pay dividends. It's also another strategy. Those companies grow at a moderate rate. It's less risky and it's less stressful. Maybe you can fall in that category as a trader as well. And liquidity is a last advantage in stock investing. Stock market allows you to sell your stock anytime. Economists use term liquid to mean that you can turn your shares into cash quickly with low transaction cost. That's important. If you suddenly need your money, since prices are volatile, you run the risk of being forced to take a loss. So we talk about the advantage of stock trading, stock investing, and now let's talk about disadvantages of stock investing. There are 6 disadvantages of stock investing that I prepare for you. First of all, the biggest one is risk. You could lose your entire investment if a company does poorly. Investors will sell, sending the stock price plummeting. When you sell, you will lose your initial investment. If you can't afford to lose your initial investment, then you should buy bonds, obviously. But this is the worst case scenario. Doesn't mean that I'm not trying to frighten you to invest in stocks, but you need to consider risk part of it. Common stockholders paid last. Preferred stockholders and bondholders or creditors get paid first if a company goes broke. But that happens only if a company goes bankrupt. A well-diversified portfolio should keep you safe if company goes under. For the time, you need to spend time on research each company, determine how profitable you think that it will be before you buy its stock. You must learn how to read financial statements and in reports and follow your company's developments in the news. You also have to monitor the stock market itself, as even the best companies' price will fall in the market correction, the market crash, or bear market. Taxes, there are another disadvantages. If you sell your stock for a loss, you may be able to get a tax break. However, if you sell your stock for a profit, you would be liable to pay capital gains taxes, obviously. But if you lose, you won't get paid any taxes. Emotional roller coaster. So stock prices rise and fall second by second. Individuals tend to buy high out of the greed and sell low out of the fear. The best thing to do is not to constantly look at the price fluctuation of stocks, just to check on a regular basis. And there is also professional competition going on with the institutional investors, and professional traders have more time and knowledge to invest. They also have bigger, sophisticated trading tools and financial models and computer system at their disposal. So you will be competing with these guys. Firstly, I mentioned as a diversification. Let's talk a little bit about it. Diversification is to reduce your investment risk, such as investing in different type of assets across different sectors, so that you spread out your risk. By this way, if one type of stock or asset goes down in value, but other types of investments go up or stay the same, your entire portfolio is impacted in a big way. Here are some ways you can diversify your stock investment. You can diversify according to investment type. Diversified portfolio will provide the most of the benefits, fewer disadvantages than stock ownership alone. Mix of stocks, bonds, commodities. So over time, it's the best way to gain highest return at the lowest risk. You can also diversify by company size. There are large caps, mid caps, small caps companies. The cap stands for capitalization. It's total stock price times the number of shares. So I'm going a little bit details, but just to give you the idea how they are categorized. It's good to own a different size companies because they perform differently in each phase of the business cycle. For example, large cap companies are considered more stable, less susceptible to share price volatility. On the other hand, small cap companies might be riskier, prone to share price volatility, but offer greater growth potential. You can also diversify by location. All companies located in the United States, Europe, Japan, and emerging markets. Diversification allows you to take the advantage of growth without being vulnerable to any single geographically. The bottom line, there are clear benefits and drawbacks of investing in stocks. Historically, stocks have generated generous returns over the long term, but investing in stocks also comes with significant risks, as we mentioned. In disadvantages, risk of stock investing can be spread across different stocks, sectors, geographies, and a process called diversification. So that's it from my side. I think we get the basic idea, idea about investing in stocks. Now we have a clear vision how to do it. You can contact with our support members, so you can also open accounts and invest accordingly. Thank you so much. Enjoy your weekend.